These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, that end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation we will be entering and adjusting entry related to prepaid insurance into our bookkeeping problem in Excel, keeping in mind how that same information would be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're first going to take a quick look at QuickBooks and then jump over to Excel and enter the data there. When thinking about the adjusting entry, we are looking at the prepaid insurance. Prepaid insurance is one of those types of accounts where we're going to tell the accounting department to just every time they purchase insurance or pay for insurance, rather than debiting the insurance expense account, just to put it into this asset account. That's part of our system, that's part of our process, so that as of the end of the time period, we can go in there and adjust that. Why would we do that? Because the prepaid insurance is something that by definition we pay for before we consume it, and therefore at the point of purchase it's an asset. It's something we haven't yet used, it's not something we have consumed, and we're not going to put it or leave it up to or require the accounting department to periodically look at that throughout the month. What we will do instead is look at it periodically at the end of the month and determine how much of that prepaid insurance has then been earned and therefore needs to be taken out of prepaid insurance and recorded as an expense, reducing the prepaid insurance and recording the related expense. Now, in accounting software such as QuickBooks, as a similar way as it will be in Excel, we would typically use journal entries as we do with all these adjusting journal entries. However, it is possible within QuickBooks to enter this type of adjustment using the registers. We are going to use the journal entries as we post this in Excel. Here we are in Excel. We're in our adjusting entries worksheet and we will be entering the adjustment for prepaid insurance. This is going to be a pretty normal adjusting journal entry. We'll see it all the time in an adjusting journal entry type of problem. And like most adjusting journal entries, it'll follow the standard rules, which means that we're not going to have any cash involved in the account in this journal entry. There's going to be one balance sheet account above the equity line, and it's going to be related to something that has to do with insurance. And if we look through them, we see prepaid insurance. That's one of the accounts that will be affected. I'm going to go ahead and right click next to that and make it yellow to indicate that that will be one of the accounts. There will then be one account below the equity line in the revenue and expense section down here. It's going to have something to do with insurance. And if we look through that, we see insurance expense. And so that's going to be here. So it's in, I'm just going to make that yellow right next to it. That's going to be the other account affected. Again, if we don't really even know what's going on, we could just pick up these two accounts knowing it's an adjusting entry and it has a balance sheet account and an income statement account. And we can even know which way it's going, in that we know that all income statement accounts have debit balances and they only go in the debit direction up, and therefore the insurance expense is going to be debited. So I'm going to debit the insurance expense by copying it. We're going to copy that, right click and copy. Scrolling back up to the top, we're going to put it into the new journal entry here, and we're going to say 228. We'll put this on top in B19, right click and paste 1, 2, 3. And then we're going to credit the other account involved, which in this case will of course be prepaid insurance. So we will copy prepaid insurance, scroll back down, that's going to be in B20, right click and paste 1, 2, 3. Then we're going to indent this. We're in the Home tab, we're in the Alignment group, and we are increasing the indentation. Now we just need to know what the amount is going to be. And in order to determine that, we'd have to figure out how much of this insurance that has been paid for has been used. A book problem could state this in two different ways. They may say that we have consumed or used what we're going to say 917 of this. And that means they gave us the actual expense number. That's what we would use. Or they can give us the amount that would be left. So if they said something like the unearned amount is 10,083, then what they're giving us is not the amount that we need to put in our journal entry there, but they are giving us the amount that we need this account to be after we record it. So we'd have to do a subtraction problem. We take the 10,083 minus the 11,000, and that would give us the 917. The other way we could figure this out is that we actually look at the policy term. This would be what we would do in practice. We'd have the policy term, we paid for the 11,000, and we're going to say that we paid for, in this case, a 12-month time period. And then we just need to figure out how much of those 12 months have passed, and that's going to be the amount that has expired as of this time point. Therefore, we'll take the 11,000 divided by 12, and we're going to say that 916 has passed at this point in time. So that's going to be our journal entry. We'll do that one more time over here. I'm going to put that same calculation here. We are in cell C19 equals 11,000 times or divided by 12 months. That's going to give us 917. It is rounded, so note that it is rounded there. We're going to credit for the same amount. So there we have it. We're going to record this. So here's what we will be recording in the journal entry, and we will record that to the adjusting column in our worksheet. Looking for insurance expense, we see here the insurance expense. Note there was $25 in it that has now been moved to interest expense where it should be, but we are in insurance expense, recording the insurance expense at this point in time. We are in cell M27. We're going to select equals at that cell and point to that 917, bringing the balance up from 0 by 917 to 917. That then puts us out of balance, of course, and it brings net income down. So the effect on net income here, remember net income is the revenue of credits minus the debits of expenses. This is income on this sheet. This is where we started. This is the activity that has happened, and we are now reduced in income from 6,847 down by 842 to 6,005. Let's record the other side now. We have the prepaid insurance. That's going to be up top. We have the prepaid insurance here in, it's the fourth account down. We want to be in M6. We are in cell M6. We will select equals, scroll down just a bit, and point to that 917 credit. Let's do that now. Scrolling back up, we are in cell M6. We're selecting equals, scrolling down just a bit, and pointing to that 917. When we select equals, it's going to take this 11,000 down to 10,083. So that's going to leave us, if we say that the 11,000 was 12 months and 1 month has now passed, this 10,083, if we divide that by the number of months left, which is 11 months, we get that 917, that 1 month's worth. Or in other words, if we take the 11,000 for the year, 12 months, divided by 12, we get the 916. If we're saying 1 month has passed, then we still have the 11 months left. So if we multiply that times 11, that's what this number should be. So we can kind of double check our numbers a couple different ways, both on the expense side and what is still left in the prepaid insurance. Remember that a book problem could ask you or give you the data either way. They could tell you, this is where we're at now, and this is where we need to be, meaning you need to do a subtraction problem to get to that. Or they could just tell you, this is the amount of the prepaid insurance that has been consumed, and just give you the actual number that will be used in the adjusting journal entry. Hello, in this presentation we will enter adjusting entries related to prepaid insurance within QuickBooks Pro 2018. If you've been following along with us, we will be continuing with the Get Great Guitars problem. If not, that's okay. We will be doing adjusting entries related to insurance, discussing what they are, how to do them, and why to do them. If you have the backup to this point, you can restore that at the File tab and Restore. If we currently have the Open Windows list open, in order to open the Open Windows list, go to View, Open Windows List. The only open window is the home page at this time. That is at company and home page. What we're going to do now are adjusting entries, those entries at the end of the time period in order to make the financial statements correct at that point. They are part of the normal process. They're not problems or errors that have been made by the accounting department. And in specific with relation to insurance, we often set up the insurance in such a way that we say when we write the check for the insurance, we're just going to say write a check, credit the check, and debit prepaid insurance, because by insurance's nature, we typically buy it for at least a month, but oftentimes more than a month in advance to us using the insurance. And therefore, if we just expense it at the point in time that we buy it, then it's going to distort our income statement pretty badly, because we're going to have this huge expense at the point in time that we bought the insurance, even though it's really covering the other months. So when we compare month to month, we end up with a problem. So let's take a look at that, and let's take a look at how we can adjust that. So we're going to go to the reports up top. We're going to go to company and financial, scroll down first to the balance sheet, and we're going to select then the date range, go into the customize reports, and we're going to select 01/01/212 02/28/21, January 1st, 2021 to February 28th, 2021. There is our balance sheet. We will be concentrating this time on this $11,000 there in prepaid insurance. Double clicking on that, we see that we have the $11,000 here happened at the end of January that we paid for this. If we double click on that, we see that we actually wrote a check for this amount. The thing to note here is that we put this to prepaid insurance rather than insurance expense, which might be what we would think that we would want to put it to is insurance expense. However, if we did put it to an insurance expense, by the way, that's not a problem. We can do basically the reversing of this adjusting entry in order to adjust for that. But let's see why that might be a problem, and under an accruals basis system, why it's not really proper to do that. So we're going to close this out. Also note that as we do this, I'm going to close this out. The fact that we have an accrual thing checked off here and not cash does mean that QuickBooks is trying its best to record on an accrual basis rather than a cash basis. However, does not necessarily mean that we're all on an accrual basis. We do still need to make these adjustments in order to be really on an accrual basis in terms of reports that we want to process. And so let's look at some of these differences and why that might be the case. So if we go to reports up top, we go to company and financial, and we go to profit and loss standard. We can change the date range from 01/01/212 03 02/28/21. So January 1st, 2021 to February 28th, 2021. Now you can imagine what would happen if we put that $11,000 as an expense here. It's currently on the books as an asset. If we put it as an expense specifically in the month of January for $11,000, we would then show not income but a loss for that time period because of that $11,000. Now, in one sense, it's true that we spent $11,000, but if we were to compare, say, January and have that $11,000 expense to February, in which we didn't pay the $11,000, but for which the insurance is covering us for, it doesn't seem quite proper. We would like to use the matching principle to apply that out. We'd like to say, hey, February, we did just as good, all else equal, as we did in January, and we should be applying the same amount of insurance given the fact that the insurance is covering both January and February. We shouldn't be measuring February's performance, in other words, based on the fact that they did better because we didn't buy the insurance in February and we bought it in January. We shouldn't be docking January's performance simply because that's when the insurance happened to be purchased, but the insurance was purchased for 6 months. So what we need to do is allocate that in order to cover the time period that's being covered by the insurance. One system to do that, one good system of doing that, is to set up the insurance when we purchase it, not as an expense as we have here, but a prepaid account. So if we go back to the balance sheet, that in essence is what we have done here. So we're just going to set up the system. Whenever you write a check for insurance, it's not going to go to insurance expense, it's going to go to prepaid insurance. And then at the end of the time period, at the end of the month or the year, our adjusting department, ourselves, or an outside CPA firm can go in and make the adjustments necessary to be on a proper accrual basis. What would that adjustment be then? We'd have to say, okay, well, here's what we paid for the insurance. In this case, we're going to assume that that covered 12 months. So we paid $11,000 for 12 months. We paid for it at the end of January or the beginning of February, and that means that one of those 12 months have now passed. So what we're going to do is we're just going to take that 11,000 divided by 12 months and about $916.66, and we can round here. This doesn't need to be exact for these adjusting entries as long as we want it to be something that's materially worthwhile for us to do. So we're going to say it's going to be 900, let's just say 917 will be the amount rounding to the dollar that we will make the adjustment for. And the adjustment is going to be recording the expense related to that 1 month and decreasing the prepaid insurance, meaning the asset's going to go down. We no longer have this insurance that we're going to consume in the future without having to pay for more of it. And we're going to recognize the fact that we consumed the use of the insurance by being covered over the prior month. Typically, the way to do this would be to go to Company and make journal entries. And if we do debits and credits, we would debit insurance expense and credit prepaid insurance for that 917. But we're going to do this with registers so that we can not use the journal entries and try to use the journal entries as few as possible and just use a register to do basically the same thing. So we're going to go to the banking here, and we're going to go to Use Register. And we're going to look for that prepaid insurance. So we'll select the drop down. We're going to go to Prepaid Insurance and OK. And we're going to make our adjusting entry as of the end of the month, as of 02/28/21. And we're going to say that this account is going to go down. So it's going to be a decrease of 917. And then all we have to do is choose the other account, which in our case is going to be insurance expense. We could select the drop down and find it, or we can just type in insurance expense. There it is. There's the expense account tab. And what QuickBooks basically is saying, okay, we want to decrease this account that we are in, the prepaid insurance, and then we're going to do the opposite to the insurance expense, which QuickBooks can just know that that's the debit or the credit, and do the other to the other. And so that's what's happening here. So in essence, this is a journal entry. It's going to be decreasing the asset account, which is a credit, and it's going to be debiting the insurance expense account will be the other side. And if we just look at the increase and decrease and use some trial and error, we can see that it's going the right way. So we're going to say OK, and then go back to our balance sheet and see if it does what we want it to do. What do we want it to do? We want that 11,000 to go down to this number. So let's see that. We'll go to the balance sheet. Here is prepaid insurance. And in essence, that's what should be left there is 11 months worth of insurance, right? So we said it was 916 about for each month. If we multiply that times 11, the number of months we have left, we have about 10,083 left that we will be consuming over the next 11 months. So then we're going to go down to the profit and loss and see if it does what we expect it to do here. That is, the prepaid insurance is recorded. Here's the insurance expense. If we double click on that insurance expense, we'll see that there are a couple items in there that were posted to the wrong area in a prior presentation. So I'm going to go ahead, I'm going to correct that in a format that by adjusting them here. So I'll show you how to do that, and I'm also going to tell you that QuickBooks allows us to make these types of adjustments, adjust these entries. Some software will not. We would have to make a journal entry to do this. So let me show you what the error is, and then we'll go ahead and fix that. So if we double click on these, there was two of them. This account went to insurance expense, and it should be going to interest expense. So typing that into quickly, it should be interest expense. So I'm just going to change that account and then say save and close. And there's the item now. So if we do that to the two items that are in there, then what we have done is move the expense account. Those two items should have been an expense, but interest expense. And then the insurance expense here if we double click on that item, will now solely be this 917, the 1 month worth of insurance expense. And that's going to be the other side of the item. It's going to be decreasing our net income. So note that these adjusting entries have put us into a loss down here.